Happy Hump Day. For today's Word Up Wednesday, we're going to be talking about the gains. But not just protein gains, capital gains tax. So what is capital gains tax? If you are discussing capital gains tax, chances are you're about to make money on one of your investment properties. Congratulations. Now the government needs to take their share of the profit. First, let's analyze what an investment property is. So an investment property is any property that you don't live in. So let's say that you bought a property as a rental. Let's say you bought a vacation beach house. Let's say you bought an office or a retail store or some type of commercial property. Let's say you bought a chunk of land just to sit on. Any of these that is not your primary residence is considered an investment property. Your primary residence is also considered an investment property if you sell it before you've lived in it for 2 years. How is capital gains tax calculated? So let's say you bought your property for $350,000 last year. You're selling it for $500,000 this year. That's a $150,000 delta. Of that, you'll probably pay a percentage of that to real estate commissions, closing cost, as something like a buyer's title policy, a survey, anything like that. And what you're left with at the end, let's call it $100,000, is what you'll be paying tax on. The capital gains tax is 15% of that profit. So when are you exempt from capital gains tax? So you can be exempt from capital gains tax if you as an individual, your work salary is less than $40,000 a year, or if you as a married couple earn less than $80,000 a year. The other way you can be exempt from capital gains tax is if you've owned that property as your primary residence for at least 2 years. Once you've owned it for 2 years, the government gives you the pass on paying capital gains tax because they see it as your home and not strictly as an investment property. If it's your home but you haven't lived there for 2 years, it's still considered an investment property. The other way to get around paying capital gains tax is to roll it into a 1031 exchange. A 1031 exchange is a little tricky. You do have to get a lawyer involved, but basically what happens is you're an investor, you bought investment properties, you're going to owe a significant amount to taxes, but instead you want to buy a bigger investment property. The government says, okay, well, we can defer your tax payment until you sell the bigger investment property because we're going to make more money. So you're able to roll that payment into your next property. You do have to purchase another property within 90 days. Again, you need a lawyer to draw up the paperwork. It's not something that you only need yourself and an agent to do. So that being said, if you're looking at selling your house and you've only owned it for a year, do be mindful that capital gains tax is a thing, and come tax season, do expect to get hit with a bill for it. Easiest way to avoid it, own your home for at least 2 years. So once you hit the 2-year mark, look at your value. Maybe it's worth selling, or maybe you love living in the home and you just want to keep it. Regardless of what you choose, would love to talk, would love to help you buy an investment property. DM me. Let me know if you have any questions on this. Definitely a more technical video.